in and buying in too, and that includes our next guest. He tweeted on Tuesday that he'd gone long through call options. Chamath Palihapitiya is the CEO of Social Capital. He joins us now on the phone. Chamath, thank you for being here.
Hi, Scott. How are you?
I'm good, thanks. So you tweeted yesterday that you bought $115 calls in GameStop. Can you tell me what your position is as of this very moment?
Yeah. Can I tell you a little story before all of that, or no?
Why don't you tell me that first, and then we'll go from there.
So this morning I woke up after spending all last night in Wall Street bets, reading about all of this stuff. I ended up closing up my position this morning, and I wanted to announce that I'm taking all the profits that I made, plus my original position. So I'm going to take $500,000, and I'm going to donate to the Barstool Fund for Small Businesses. But I really want to tell you, beyond the 500 grand donation or the money that I invested, which was, not a huge amount in the grand scheme of that stock or the entire market, what I learned, because I think what I learned over the last couple of days is important for everybody that's watching CNBC.
And that is?
I think that what you're seeing is essentially a push.
So just to be clear, what you're seeing here is a call that happened yesterday, but if you try to YouTube this particular interview, it's getting taken down everywhere. CNBC is flat out taking it down, so the only way to keep it up right now is by having other creators talk over it, add value to it, show their face on top of it, because that doesn't follow the same copyright laws. When you do that and you substantially transform the material to make it your own, CNBC can't just claim it and take it down. So what we're doing here is we're going to go over this interview at key points, and we're going to talk about it, and that way you get to see the whole thing without it being cropped into 3-minute segments, and the community gets to leave it up on the YouTube channel.
Back against the establishment in a really important way. You have a lot of people, and I would encourage anybody who is dismissive of this thing to go into Wall Street Bets and actually just read the forums. And I think that you're going to see 3 kinds of posts. The first kind of content are a lot of people doing some incredible fundamental diligence on companies, trying to think about long-term value. And in my opinion, many of them are doing as good and frankly a better job than a lot of hedge fund analysts that I work with. That's number one. The second are a lot of people who believe that, coming out of 2008, what happened was Wall Street took an enormous amount of risk and they left retail as the bag holder. And a lot of these kids were in grade school and high school when that happened. They lost their homes, their parents lost their jobs, and they've always wondered, why did those folks get bailed out for taking enormous amounts of risk and nobody helped and showed up to help my family? And then the third thing is a realization that instead of having idea dinners or, quiet whispered conversations amongst hedge funds in the Hamptons, these kids have the courage to do it transparently in a forum. And I'm not saying all of it is perfect by any means, but I think it takes an enormous amount of faith in the system to be that transparent, to talk about things, and then for each individual to make their own mind up and to do things, whether it's to buy and to sell. And I think that what it proves is this retail phenomenon is here to stay. There are 2.7 million people inside of Wall Street Bets. I think that they are as important as any hedge fund or collection of hedge funds.
This is a good time to pause. I just want to bring up this tweet for everyone. Hopefully you can see it on the side there. I think Chamath's point about 2008 is really important here. I'll leave this up for just a minute, but I was definitely in college during 2008, and I'm lucky I didn't graduate that year. But for example, I have plenty of friends who graduated that year and the year after with, 6 figures worth of student loans that they couldn't pay off because, for example, bankers somewhere decided to take on too much risks. The market tanked and then they just got bailed out, right? So just to drive that point home, I think no matter what your age, you have definitely felt the consequences of 2008 and beyond. And now we're kind of just seeing the flip side of that, right? Where people are facing the consequences of their actions, but because they're big institutions, they get to keep changing the rules of the game. So I think we're going to be seeing a lot of fallout from this for days and days to come, and hopefully for weeks, months, and years to come. But I just want to bring to your attention that this 2008 analogy isn't just like, oh, hey, remember when the establishment did something bad this one time. I think everyone on Wall Street Bets, I certainly, and others in my community, definitely feel that way for real, where, there's almost two sets of rules. And that's not only unfortunate, it's flat out unfair. So let's keep going with the interview.
And I think the most important thing is that in a world of zero interest rates and quantitative easing, I don't know how you can run a typical hedge fund strategy and make money anymore. Because, for example, when you looked at GameStop, a normal person would say, how can you have 136% short interest? How can you be short 40% more shares than actually exist in the world? To a normal person, that doesn't make any sense. But to a Wall Street mathematician, that's the game that has been played for years.
By the way, just a quick note here, the way you can be short over 100% on a stock is something called naked shorting, where you can actually short a stock without actually buying the underlying stock in order to sell it at a cheaper price later. So if you're interested in that, go look up naked shorting, and you'll see how this wonky voodoo magic can actually happen. But that's what happened with GameStop, and it was a really great target for Wall Street Bets. They were really smart. This wasn't a lucky pick. They went and honed in on a stock that was over 100% shorted, knowing, what their actions would cause. And I think that's awesome. I don't think that's crazy. I think Wall Street Bets and retail in general, as I preach on this channel all the time, is much smarter than institutions give us credit for, give you credit for. And I think that's what we're going to keep seeing more of, is people championing the cause like Chamath, like Elon Musk, coming out and saying, hey, retail investors are just as important to the picture, if not more so, than these slow, junky institutions, right?
And that game came undone.
Well, I mean,
so
that may be that may be somewhat of an extreme example. Let me just go through a couple of things you said here. I have a hard time believing. I mean, you suggested that there's a good amount of fundamental research going on underneath the GameStop Reddit situation. Do you truly believe that there's actual fundamental research? Not to disparage in any way the people who are actually making these trades, but this seems to be momentum rather than a deep fundamental analysis.
Scott, there's momentum in traditional hedge funds and how they move stocks as well. But it's really disparaging if the starting position is these guys can't do the same quality of research as an analyst in a fund. That's just not true.
I didn't say that. I didn't say they can't do that kind of research.
I think what we're seeing here is, a fundamental misunderstanding of what institutions and, CNBS analysts think that retail investors are doing before they hit that buy button, as opposed to what we're actually doing. I can attest in my own community, we do a bunch of great research in multiple channels focused on disruptive innovation. I know in other communities, people are laser focused on doing deep fundamental analysis, stock by stock, sector by sector, industry by industry. So I can't, frankly, I can't stand it when people in fancy suits and ties come and say things like, oh, retail investors are unsophisticated. They're unable to do anything. They should stick to index funds and just put their money in the S&P and let the big boys play, the real game. Retail investors were the first ones right on Tesla, and they're going to be increasingly in front of, slow money. I don't really like the words fast money, smart money and dumb money, but retail investors are fast money and institutions are definitely slow money. And we're going to be seeing a lot of that over the coverage of what Wall Street Bets did versus how long it took institutions to realize and respond to it.
Questioning whether they're actually doing the research when it comes to things like GameStop and AMC and some of these other things.
There's a distribution. And obviously at one end, there are fundamental analysts. But on the other end, there are momentum traders that follow trends. But by the way, the dirty little secret of Wall Street is that exists in hedge fund land. The reason why this GameStop trade has caused so much pain is because at the top of the pecking order was Melvin Capital. Those guys were incredible stock pickers. They are incredible fundamental modelers of companies. Okay, Gabe Plotkin is one of the sort of giants of our era, of my era, right? But at the end of the day, what happens is, irrespective of what he puts on, his trades are mimicked and copied by umpteen other hedge funds that follow along. For every LP that can't get into Melvin, they get into a copycat fund that works basically like Melvin. And so when the trade goes against him, then it goes against all these people all at the same time. So the reality is there are fundamental momentum investors in the market that are organized capital, i.e. hedge funds, and disorganized, loosely affiliated capital, i.e. Wall Street bets. And I think what you're seeing is the push and pull of that, and the realization should be that if every person was forced to publish their fundamental research, it would be hard to distinguish the best version of research from Wall Street bets and the best version of research from a hedge fund. They don't have an edge. And this is what you're exposing, is that that edge is gone. And now all of a sudden, you know, retail can be on the same footing, and they don't have to be the bag holder to Wall Street.
But let me ask you this. I mean, but somebody from retail is going to eventually be the, to use your words, bag holder in this situation, are they not? And do you think it's responsible for you and some other big names who tweeted about it yesterday and to get involved yourself, knowing that you guys are considered the Pied Pipers, that people are going to follow you into these trades, and someone is ultimately going to get hurt after you and others are long gone, Chamath?
Dude, where was that message in 2008, Scott? Really? I mean, that's a joke. For example, let's look at Tesla. Who was right on Tesla? I'll tell you who was right. Every single retail investor. I was right. Elon Musk was right. Let me tell you who was wrong. Every single hedge fund. Name after name when it comes to innovation, when it comes to growth, when it comes to people trying to do fundamentally useful things in the world. If it doesn't fit into the mold that Wall Street wants, they try to organize against it. And there has been pushback after pushback after pushback in individual names, and this is yet another form of pushback. And all I'm trying to say is the mechanics of how Wall Street has worked. And again, I wish you would ask this detailed question. Why is it allowed for somebody running a hedge fund to basically claim that they are market neutral, but be levered up? They take a $10 billion fund, and their prime brokers allow them to run $100 billion of notional exposure. Who thinks that that's fair? It's not fair to the retail investor, because when that blows up and a $100 billion hole exists in a fund, which, by the way, this is exactly what happened in 2008, the government bails them out. Who is the government? All of us. So, you know, retail has been the bag holder before. Retail hasn't caused these things before. Hedge funds have caused these things before. So if you're going to talk about taking the gun away from the baby, let's make sure we figure out who the baby is.
Yeah, but do you think that you helped fan the flames and others like you, whether it's, you know, one of the Winklevi brothers tweeting about it, Elon Musk tweeting about it, that it's ultimately driving this stock up well beyond what the fundamentals say that it should be? I mean, I don't think you think, and you tell me, do you think that GameStop is worth $350 a share?
What I can tell you is that when I put that position on, $125,000 position, I used it to acquire knowledge and learning. And what I was trying to figure out is how these positions move in the modern trading era. And what I can tell you is, up until that point, the setup made no mathematical sense. How do you be short 140% of a company's shares? That wasn't retail.
Well, maybe that's a question for regulators, that maybe the way that that's allowed to happen needs to be examined. But
I'll tell you how it's allowed to happen. It's allowed to happen so that hedge funds can charge 2 and 20 to their limited partners, independent of consequences. I'll tell you another way that it's allowed to happen. Hedge funds are allowed to take their money, go to a prime broker, and all of a sudden get 10x multiplication on that money. That's the problem. You have trillions of dollars of notional being traded by these organizations. You have maybe billions of dollars being traded by retail.
I want to get back to the issue at hand, which I don't feel like you answered the question.
By the way, just a quick note here before we move on. Governing is one thing, but sometimes the government is in on it too. And if you don't believe me, I invite you to remember back when the whole pandemic started and senators got caught selling out of all of their positions right before all the announcements went public and the markets crashed, right? So I invite you to look at the tweet that I'm showing now, and then I invite you to look at the image that I'm showing now on the 4 senators or Congress people that, took their portfolios and minimized the damage before any of the news went public. So, insider trading doesn't just happen inside institutions and in companies. It definitely happens in the government that tries to regulate them as well. So that's all I'll say about that. By the way, thank you so much for all the donations. I really appreciate it. I'm just trying to get this piece of media out there and to stay up on YouTube because it keeps getting taken down. So if you're coming in late, all I'm doing is showing my face over it so that it can't get taken down because I'm adding value as a content creator to it.
This idea of, somebody's going to get hurt. You sound like you're an advocate for the little guy, so to speak, right? But yet by getting involved, why did you get involved in the first place? I mean, you said that to get information. I mean, you wanted to make money on the trade. Come on, right? You wanted to make money.
To move the needle, I need to strap on hundreds of millions of dollars. So I wanted to learn. Why did I want to learn? When I saw that article in the Wall Street Journal, I had no idea about Melvin Capital, really. I had no idea about Wall Street Bets, really. I had no idea about GameStop, except that it had been mentioned to me in a couple of tweets throughout the year. So I tweeted out after I read the article, hey, folks, tell me an interesting trade that I can put on tomorrow for a few $100K so I can learn, basically. That tweet got 10 million impressions and 13,000 comments. And when I went through there, a lot of people pointed to GameStop and pointed to Wall Street Bets. And when I went in there and started to look around, what I thought is, my God, here is a dynamic about trading, about momentum, about stocks, about short interest, about gamma squeezes. These are not things that I know a lot about, and so I put in a small position to learn. And what I learned is that people can do fundamental research, come to a point of view that's diametrically opposed to organized capital, and they can be right. And I'm allowed to be on the right side of that. It's not my job to go and defend a bunch of, highly compensated hedge fund managers against losses. And just the fact that for one time those folks lost, we can bellyache and cry on national television, to me is a joke.
Well, I mean,
There's a lot of kids. Hold on a second. There's a lot of kids and a lot of people on Wall Street Bets who have made money to pay off their mortgage. I read about a post yesterday of a kid that was able to pay off his entire student loans and posted it. That's amazing progress.
I'm not suggesting, and I'm not trying to come off that way, that I'm suggesting what's happened on Wall Street Bets or what this cohort of traders is doing is wrong.
It's not.
I don't think that there's much of a difference from, and I know it's been mentioned on this network already today, but the first thing I thought of in this situation was back to the Herbalife episode, where you had a fairly sizable group of well-known hedge fund managers decide to take the other side of Bill Ackman's trade. He was, of course, short. They all went long. They made a fundamental case in their own mind, and whatever worked for them to have the conviction that they did to take that trade. Part of it was undoubtedly trying to hurt the short, who was Bill Ackman at that time. Maybe some of them did it through going to an idea dinner or whatever other forum, through personal phone calls or emails. And there was a large group of people on one side of the trade. I don't think it's any different. I don't think it's any different.
You just said it's not different. You're right. Idea dinners, that concept has existed for decades on Wall Street, where people get together in closed rooms behind closed doors and usher around names of companies, and they coalesce and decide to cooperate together. The guys on Wall Street Bets just do it in the public completely transparently.
And we just do it completely publicly and transparently in our free Discord.
In my opinion, that takes a lot more courage, because you could actually be wrong. Somebody can actually say, hey, listen, what you said made completely no sense whatsoever. And so what is the difference? In my opinion, this is the modern day instantiation of that dynamic, just writ large and at scale.
The only thing I'm concerned about is that there are inevitably going to be people who get hurt. I'm not talking about hedge fund managers. I'm not talking about them. I'm talking about the people who follow people into the trade, who think that this stock is going to continue to go up because that's what they've been conditioned to think in the pandemic.
What should we do?
Because all stocks go up, apparently.
What should we do? Not allow folks. Here's what will happen if you follow your logic, then you'll say, you know what? Retail doesn't know what they're doing. I think you're wrong. Then the thing will be retail shouldn't be allowed to participate in the stock market. I think you're wrong. And then you know what will happen, Scott? The inequality gap will grow and grow and grow. Because then what are they supposed to do then? Buy an ETF, a passive fund? They can't buy into hedge funds because the rules don't allow them to. So now systematically what you've done is you entrench poverty.
No, I mean, that's taking it too far. This is just accentuating those thoughts that Wall Street's a casino and nothing more. That's what this is perpetuating.
I don't think so. I think this is an example of if you are going to so massively oversell a company to the extent that you're selling 40 more shares of that company that don't exist, and all of a sudden other folks are like, hey, wait a minute, this is going to get squeezed, and they buy it, that's just a smart trade. Retail saw it. Wall Street missed it, and they paid the price. So maybe to your point, Scott, what regulators should do is say, hey, wait a minute, how can we allow companies to be 140% short? That doesn't make any sense. Maybe that's what should happen.
You think this overall situation is fine for the market? I'm also curious as to, look, you have taken companies public through SPACs at a rate that others have not. You're relying on the integrity of the stock market itself to be able to do what you do and be successful doing it. You don't think what we're witnessing now calls into question the integrity of the stock market, that a lot of different stocks with seemingly no fundamental story behind them to this degree can see their stocks rise in this magnitude, and all of that is just fine?
So before we keep going, I want to take this moment to answer questions in the chat. I'll keep it short and sweet, I promise, and also just separate the two things that are being said by the interviewer, whose name escapes me at the moment. I apologize. But basically, there's two things that we care about in the stock market, right? The actual stocks and then the mechanics of the stock market. So one thing that he's not doing a good job of disassociating the two, right? It's not a casino because we're all doing research on companies. It appears like a casino because sometimes there are these wonky mechanics like short squeezes and shorting over 100% of the stock and being able to do arbitrage on options and all these other things, right? So, when we all get together and say Tesla is a good company because it's solving a fundamental energy problem, we're doing something in that first part, right? Fundamental deep research on a company that's publicly traded. The thing that happened here has nothing to do with that, right? We picked a bad stock, bad in terms of fundamentals, right? A company that's depressed because it sells a physical good in a physical store, but that was subject to a strange mechanic in the stock market. It was overly shorted, and if you buy an overly shorted stock and cause the price to go up, it squeezes people out dramatically because everyone who had that stock had it in a short position, right? So column A, deep research, column B, the actual mechanics behind buys and sells for big institutions, totally separate parts of the stock market. The only time they meet is when you decide what kind of position you want to take on a specific company. That's all I'm trying to say, and all I'm trying to do is disambiguate those two things, because retail is really good at the first, and we just don't have the same level of access and power on the second as big institutions.
That there's nothing wrong with the integrity of the system if that is occurring?
The lack of integrity in the system is the precursor that caused GameStop to be sold short 136% and for people to try to pile on and destroy a company in front of our eyes. That to me feels wrong. That feels pretty un-American, if you ask me. I think GameStop is a reasonable business. I think what they do is reasonable. And so the fact that they shouldn't be allowed to exist because all of a sudden, we decide that they should be obliterated into the ground.
Well, they should be allowed to exist. They should be allowed to exist at whatever their stock should be valued at based on what their earnings are. And the stock was like
free market
$17, $18 not that long ago.
Who says that? Who says that? Do you want to make the same argument about Tesla? It's gone 10x in a few months. You don't know what it's worth. Let's be honest. Okay?
You don't think that Tesla's growth prospects?
Scott, I have my own model for the company. I'm allowed to underwrite however I want to own it. Everybody that bought that stock is also underwriting how they want to own it. And the point is, just because you're wrong doesn't mean you get to change the rules, especially when you were wrong, you got bailed out the last time. That's not fair.
Yeah, but it doesn't mean that these investors who were short the stock were necessarily wrong. I mean, I still haven't heard you tell me what the fundamental case is for GameStop at $350 or AMC theaters, which have been closed for months and months and months, is worth what the stock's trading at now, or any number of these things, the way that they're trading. There's no fundamental reason why they're there. They're trading because there's this momentum cohort behind it, whether it's on Reddit or Robinhood or wherever else.
But Scott, why is that all of a sudden so wrong to you, this kind of momentum trading? Because, for example, if you look under the hood on every quant strategy, organized, quantitative, strategic hedge funds on Wall Street, those things are all momentum shops.
By the way, quick note, if you want to stay after this video, I have another video where someone from CNBS literally tells us exactly how they manipulate the market. I realize AOC is going to be on Twitch, but if enough people stick around, I'll show that video next.
They trade day over day, massively levered, small swings. So basically what you're saying is, hey, if retail runs a momentum play to squeeze a short, that's wrong. But hey, if Renaissance Technologies and somebody else does it, that's okay. That's what you're saying. You may not know that that's what you're saying, but that's what you're saying. And to me, that feels very unfair.
No. What I'm saying is someone's going to get screwed, okay? Someone's going to get screwed. And it's going to be it's going to be a retail investor who gets screwed because they think that this is the way the game works, that this is the new Wall Street. They're new to this game. Maybe they haven't been in the game that long. Not everybody, not trying to say that in any way, shape, or form, but somebody's going to get hurt. I'm not talking about the billionaire with the big house in the Hamptons. I'm talking about the person who thinks this is cool, fun, and an exciting way to spend their time.
I'm not taking away that there's an element of that, but you're really discounting how smart so many of these people are. Okay? And all I would encourage you to do is spend a little time in these forums, go into the Discord server, and you're not going to hear a bunch of bros just sloshing around. You're going to hear a bunch of really, really smart people talking about things in fundamental ways.
Chamath, don't tell me that yesterday AMC Entertainment was a $5 stock, and today it's up 170%, and that's justified. Don't tell me that some of these names are justified to being where they are.
Scott, it's one company in one moment of time. What I'm saying is
there's like 10 companies, 15 companies, 20 companies.
You're broadly sweeping with a broad brush that says these guys don't know what they're doing and they don't deserve to do what they are doing. And what I'm telling you is there is a small part of momentum, there is a part that's fundamental analysis, and then there's a part that's just sticking it to the man. I'm not taking you away from that. But the reality is it's all allowed in a free market. And all of a sudden, if you start to gate decisions by individual people, all you're going to do is systematically lock in institutional ways of making money for institutional clients. And I don't think that's the solution. If you want to go and address the solution, fix how risk-taking happens at the institutional level, fix the precondition, fix the ability for these stocks to be so massively shorted in the first place, change the business model of funds so that they're not forced to be these small net, highly levered funds. Change the leverage ratios. Those are all institutional decisions. But don't all of a sudden look at a short squeeze where money is being made by retail and all of a sudden say, hey, they could and may be the bag holder in the future, so let's make sure that they can never participate in the future. That's crazy.
So just a super quick note, basically what Chamath is saying is, hey, the stock market is a valuable tool and it has some mechanical issues. We need to fix those mechanics and regulate how people can use those mechanics, like over-shorting. And it has nothing to do with the first part we talked about, which is the fundamentals and understanding the companies you invest in and being able to be a retail investor alongside these institutions, right? So completely separating the mechanics of the market from the things that are on sale inside the market. I'm just bringing that up again because they're both equally important to the story, but there are only fundamental issues with one of them, and it's the mechanics side. And that's what led to this whole situation.
Yeah, I mean, I didn't say that. I didn't say they shouldn't be
You
able
are
to.
saying that.
I'm not saying they shouldn't be able to participate. I'm not saying they shouldn't be able to participate.
You're saying they should participate on your terms.
No.
On Wall Street's terms.
No.
In a way where they get when Wall Street can have the best of it, they can maybe participate on the side. But then when Wall Street gets the worst of it, their parents, their relatives will just come and bail them out.
Not what I said. I'm glad they're participating. I'm glad they're making a lot of money. I just think it needs to come with a warning sign. There needs to be a hazard sign. All right? There needs to be a hazard sign.
The hazard should be, hey, FYI, for example, why isn't there more transparency in the reporting that hedge funds have to make? Every long position, every short position, and all the leverage they're taking every day. Why don't we do that? Then,
just so you're aware, hedge funds don't have to report their short positions currently, only their long positions. So they can have a lot more positions in a fund as long as those positions are short, and no one can know about it, which is fundamentally different from how we all do Yahoo Finance searches to figure out what institutions are long which stocks, right? Which is pretty important as a buy signal to a lot of the ways a bunch of us invest, but we have no idea right now who is shorting what. For example, who is shorting GameStop?
you would have a warning sign. You know why? Because people in retail would analyze that stuff so intricately, and we would know where the tripwires were, okay? The reason why GameStop happened, Scott, was not, again, because of a fundamental disagreement about valuation. It was because of portfolio construction arbitrage. Too much leverage, too much short selling, too many calls, too many put buying. All of that stuff contributed to this dynamic. That was an institutional dynamic that was created by institutional capital. So if you created transparency in reporting, that probably wouldn't have happened because a regulator would have said, hey, guys, I'm not going to let you be short 140% of a company. That's not right. And then you know what would have happened? This squeeze would not have happened. Now, so if you want to fix it, I think you got to go and ask for the same transparency because you can't all of a sudden have your cake and eat it too. Let's have hedge funds operate in the shadows, but let's then basically lambast Wall Street bets because they actually have the courage to write their stuff down publicly where anybody can see it.
I mean, look, my point is that I'm not lambasting anybody, okay? I'm glad these people are making money. That's the way it should be. That's the way it should be.
Honestly, let's face it. No, you're not, okay? And, the person that was on before you, no, she's not. And that's the issue. It's like because the rules are changing underfoot, people don't like that. Now, I'm not saying that there can't be better regulation, okay, and there can't be tighter rules. I get all of that. But what I am saying is that you have to be cognizant that we are moving to a world where normal, ordinary folks have now access to all the same information as institutional organized capital. And they will come to many of the same conclusions, sometimes at the same time, oftentimes faster, and sometimes to the opposite conclusions, and sometimes at the same time, sometimes faster.
Okay. And that's what I've been saying this whole time on Discord, on Twitter, and on my channel. Retail investors are not only the smart money, they're also the fast money. They come to conclusions much faster, and that's important. Because even if Wall Street comes to the same conclusions, if they come to it after retail gets into a position, they're driving up a position that retail is already in. That fundamentally means that retail is the smart money.
You will see more volatility like this in the future.
I want to see...
Solution, hold on a second. The solution to this is more transparency on the institutional side, not less access and ability for retail.
I want to see the white papers on all of these companies that are flying and all of the deep fundamental research that suggests that all of these stocks, and there are way more than one, this is not one stock, one story, okay? There are a lot that are fundamentally challenged in this environment, right?
I'm sorry, but how, for example, if we went back to Herbalife, were you supposed to adjudicate that and decide that one short thesis was better than one long thesis? Who are you to judge?
No, that wasn't my job.
And that's what Chamath is saying, is you're mixing point one with point two. You're mixing the fundamentals of a company up with the mechanics of the stock market that let this situation happen. It doesn't matter if a company has bad fundamentals. You can let people short it. It was the overshorting and then targeting an overshorted company. Again, both stock market mechanics has nothing to do with the underlying stock. The underlying stock could have had great fundamentals. It's just, why would you go short a stock with great fundamentals? Oh, wait, that's Tesla, right? And then this happened because of the mechanics around short selling.
Whose job then? A regulator's job before they can put the trade on? What are you saying?
Don't come here and tell me that you're suggesting that all of these stocks are up because they're fundamentally in that place.
I'm saying you and I both know that there's a massive distribution of reasons why people buy and sell securities. There's some that are purely value-oriented, about backward-looking discounted cash flows. Some other people all think about future cash flows, future product innovation, future margin construction. Other people think about momentum, and that is allowed. If you look at hedge funds, there are strategies for any which way you want to play. Some folks only short companies. Some folks only go long companies. Some folks run a totally net neutral strategy. They all exist, and I think what you're seeing is a proliferation of that kind of diverse thinking and risk-taking in retail now. Because before, retail was largely known as long only. And now, for the first time, you're starting to see more sophistication in retail. And I think, again, I'm just predicting the breadcrumbs here, and it could be wrong, is that over time, retail sophistication will catch up to institutional sophistication, that the strategies that exist institutionally will exist on the retail side. And so my point in all of this is, if you want to make the system better and healthier, force more transparency on the institutional side. Gary Gensler should get these guys to be just like what Cathie Wood does in ARK. It's so healthy for the ecosystem. What am I buying? What am I selling every day? What are my risk limits? Just make it transparent. And these kinds of dislocations may or may not happen in the future, but if it does, it'll be completely transparent, and you will see it coming. Right, and there's nothing wrong with that.
Let me ask.
Now you know why my channel is almost exclusively ARK Invest and Chamath content. I couldn't have said any of that better myself.
See this, because we've gone off for a while. At one point yesterday, went short GameStop. I don't know where he is now. John, are you still with me?
Yes, I am, Scott. I'm still with you.
Are you still short? And you tweeted at Chamath yesterday something to the effect of, "This is how it's done," and then the stock just surged.
Yeah. Well, but I know you'd find this hard to believe, Scott, but that's those spreads that I put on. I put on put spreads, and the reason for that, as you know, but I'll explain to the viewers quickly, is that you are limited in any potential loss to what you paid for the spread. So I put on hundreds of thousands of dollars of positions, just like Chamath, but I then spread it against other short positions in puts, thus creating a position where I know for sure, Scott, if the stock is above 60 by April expiration, I lose $45,000. If, on the other hand, some sort of rationality returns and that 136% short interest comes down and the stock comes down by April, if it's between, say, $60 and $30, I'll probably make $200,000 or $300,000. So it was me saying to Chamath, here's a way to put on a bet against the squeeze that's going on here. Chamath did a fabulous job buying calls, trading out of those calls, and making a nice profit. And by the way, Chamath, I also donated to the Barstool Fund this morning before we came on air, even before I heard that you did. And any of the profits I make from this trade, if it's 60 or below, all of that is going to be going to the Barstool Fund over with Dave Portnoy and the guys.
I think that that's awesome. Can I say something? I just think
Sure.
like this is the exact thing that I'm talking about. I don't think that, John, you did a one-pager and a massive DCF. I think you're a sophisticated investor who, through a lot of experience, has figured out what you're good at. And, and when you saw this opportunity, your spidey senses went off and you put a trade on. And it's a momentum-driven trade. There is no difference, Scott, between John and, to be honest with you, most of the people on Wall Street bets. Nothing. Maybe the net worth. But I'm telling you, these kids are catching up fast because they know what they're doing too. And the reason they know what they're doing is because of companies like Google and things like the internet that just make every piece of information available. They give you access to compute resources. You could be a kid sitting at home writing models into Google Cloud that give you the same compute power as the best hedge fund, as the best investment bank.
That's you. That's us.
And this is what I'm trying to get across to you guys, is we are leveling the playing field. It is happening. And so there are a lot of people as compelling and as smart as John that you guys don't know about that are just behind a screen name. And I think that's okay. And I think we just have to embrace the fact that this is where we're going.
Sure. I think we also need to be cognizant, though, and I
You want to see his one-pager, by the way? Are you going to hold John's hand and make sure that, before he crosses the street? Is that what you also want to do?
Because John, because unlike you, John didn't suggest otherwise, that there were fundamentals involved. He didn't, right? So I don't need a one-pager. That's part of my point. But that's what we need to do.
So what are you, the free speech police now too? I mean, come on, Scott. Like, what are you saying?
I mean, that sounds funny, and I'm sure that'll play well on Twitter. But I don't know what does that mean. I mean, I'm saying that clearly we're in a moment of time in the market. Okay. Where fundamentals for some stocks obviously don't matter, okay? Nobody, I don't care who they are, is going to come here and tell me that the fundamentals are behind a lot of the moves in these stocks. They're just not, okay?
And he's still stuck on the fundamentals. Again, Chamath is pointing out a mechanics issue in the market, the way the market is driven by allowing people to short a stock by more stocks that are available in the total float, let alone the actual float that's being held. When Wall Street Bets locks 90% of the float down, we can't short against that because nobody's willing to sell. That's what causes the squeeze, right? So everything Chamath is talking about is mechanics, and everything Scott is talking about is fundamentals. They're not talking the same language, and that's why Chamath is making fun of him. Not just to make fun of him and sound good on Twitter, but literally because he can't grasp the point that this is a mechanics issue, mechanics that are traditionally left up to sophisticated investors until the tables get turned.
Period. End of story. They're just not. It's a moment in time. Some say this is emblematic of a. Some say this is emblematic. Hang on. Some say this is emblematic of a bubble. Okay.
Can I ask you a question?
I'm concerned about people getting hurt in what may end up being a part of the market that's in a bubble. That's all.
When stocks trade down, okay, in moments of dislocation, I don't know if over the last 3 or 4 years you guys can throw up a chart, but there are times where you'd see tip-to-tail drawdowns of 5, 10, 15% over the course of days and weeks. What are we supposed to do in those situations? Just stop the market so that it can't go down?
No, but this is
just like you can't stop the market from going up.
Like, this is you admit. I mean,
Scott, you're getting into trying to judge, and my point is you can't judge, so don't try. Okay? You have to understand and believe that there is so much information out there that people can be on a level playing field, and that the most important thing we need to do now is shine the light into the corner of the market that is still opaque. And there is only one area. Companies are forced to publish every single thing about themselves transparently every quarter. Okay? ETFs publish their positions every day in some cases. Retail talks about what they're doing with transparency every minute. But institutional capital can still hide. And so if you want to create a truly level playing field that evens these things out and minimizes volatility, force these folks to show you what they're actually doing under the covers. And when you see that some of these funds are taking $50 billion and running it like $500 billion, I think we will all say, wait a minute, now that's the real risk in the room, not a bunch of guys, momentum trading like John's doing.
Look, I understand. I'm glad we had this conversation. I think it's an important one to have. It's a moment in time that we're going to look back on And this may be the story of 2021. We shall see. It's a long year, and it's early. Last but not least, because I don't want to leave this out, and Kara Swisher would be mad at me if I did, the governor thing. Is that real? You really want to be the governor of California?
Here's what I will say. I think Gavin Newsom has done a terrible job. I think that people are leaving in droves. Crime is really high. Our education outcomes are the worst of any state. Our taxes are the highest of any state. Our air quality is the worst of any state. And so this is a state that I think is just so absolutely incredible, but right now is being run off the rails. And to the extent that we can recall him, and to the extent that my agenda, which I just tweeted out and explained, resonates with people, 0 state taxes, a minimum teacher salary of $70K, school vouchers so that you have school choice, $2,000 for every kid born in California. I think you would see a renaissance in California that would be glorious. So that's what I'm willing to say right now. First step is we need to recall Gavin.
All right, we'll leave it there. To be continued. Thanks for your extended time today. I'm glad we had this conversation.
Scott, can I just say one thing? I love you. Be on the right side of history, big boy. Be on the right side of history.
So that's it for that video. I have one more surprise video for you that I hope you really enjoy.
I don't know why, but today seems like it's gonna be a great day.
Whoops, not that one. Sorry.
Welcome to Wall Street Confidential. I'm Aaron Task, joined again by Jim Cramer. Jim, welcome.
Good to see you.
Thanks for being here. There's a lot of economic data out today, but I want to talk about something else first. Again, today we have the misdirection from the futures. The futures pointing to an up market, and as of right now, stocks are down again. Is this just because it's the holiday period that we're seeing this?
You know, a lot of times when I was short.
If you don't understand that gag, listen to how many times Jim Cramer sniffles during this interview.
At my hedge fund, and I was positioned short, meaning I needed it down. I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher, and maybe commit $5 million in capital to do it, and I could affect it. What you're seeing now is it probably is bigger market now. Maybe you need $10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday, and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. That's going to create a negative view. That's a strategy very worth doing when you're valued on a day-to-day basis. And I would encourage anyone who's in the hedge fund game to do it because it's legal,
right?
And it is a very quick way to make money and very satisfying.
Okay. Well,
by the way, no one else in the world would ever admit that, but I can care.
That's right, and you can say that here.
I can't. I'm not going to say it on TV.
Well, on a related note, there's so many more hedge funds today than when you were managing your hedge fund.
Right.
Do you think that does that exacerbate the moves, or does it make it tougher?
Well, you know, the hedge funds are positioned long short, okay, not just long like mutual funds. So it's really vital these next 6 days because of your payday. You've really got to control the market.
Just so we're clear, this is in 2006. The next 6 days close out the year. So what's happening is Cramer's talking about market manipulation towards the end of the fiscal year and the end of the fiscal quarter, so that hedge fund managers hit their numbers and their targets for the quarter and, the fiscal year.
You can't let it lift. When you get a research in motion, it's really important to use a lot of your firepower to knock that down because it's the fulcrum of the market today. So let's say I were short. What I would do is I would hit a lot of guys with RIM. Now, you can't foment. That's a violation of
Foment?
Yeah, you can't foment. You can't create yourself an impression that a stock's down. But you do it anyway because the SEC doesn't understand it. So that's the only sense that I would say this is illegal. But a hedge fund that's not up a lot really has to do a lot now to save itself. So this is different from what I was talking about at the beginning, where I would be buying the Qs and stuff. Right. This is actually just blatantly illegal. But when you have 6 days and your company may be in doubt because
I feel like I should replay that, so I'm going to.
You're down. I think it's really important buying the Qs and stuff.
Right.
This is actually just blatantly illegal, but when you have 6 days and your company may be in doubt because you're down, I think it's really important to foment, if I were one of these guys, foment an impression that research in motion isn't any good, because research in motion is the key today. So, you would hit this guy and that guy, and when you would see an offering, when you see a guy who's bidding, you'd wipe out that guy very quickly. And what I used to do was called, if I wanted to go higher, I would take and bid. And if I wanted to go lower, I'd hit an offer. And I could get a stock like RIM for maybe, that might cost me 15, 20 million.
So he's talking about literally pumping and dumping, or doing the opposite, coming out with hit pieces and offering low prices over and over, or pumping a stock and then selling at high prices over and over, just in case you're not catching him because his sniffles are causing him to talk too fast.
Annie, to knock RIM down. But it would be fabulous because it would beleaguer all the moron longs who are also keying on research in motion. So
we're seeing on today with RIM,
we're seeing that. That's, again, when your company's in a survival mode, it's really important to defeat research in motion and get the Pisanis of the world and the people talking about it as if there's something wrong with RIM. Then you would call the journal and you get the bozo reporter on research in motion, and you would feed that there's a Palm's got a killer it's going to give away. These are all the things you must do on a day like today, and if you're not doing it, maybe you shouldn't be in the game.
Okay. Another stock that a lot of people are focused on right now seems to be Apple.
Yeah, Apple's very important to spread the rumor that that both Verizon and AT&T have decided they don't like the phone.
Right.
That's a very easy one to do because it's also, you want to spread the rumor that it's not going to be ready for Macworld. And this is very easy because the people who write about Apple want that story. And you can claim that it's credible because you spoke to someone at Apple, because Apple doesn't.
Right, they're not going to comment. They're not going to say.
So it's really an ideal short. And I would, again, if I were short Apple, I would be working very hard today to get that. And the way you would do that is you pick up the phone, you call 6 trading desks, and you say, listen, I just got off the phone with my contact at Verizon. And he has already said, listen, we're a Lucky G house. We're a Samsung house. We're a Motorola house. There's no room for Apple. They want too much. We're not going to let them in. We're not going to let them do what they did to music.
This is so, wait, where does Kramer work again? What channel is he on? I can't remember. It's probably not important.
And, I think that's a very effective way to keep a stock down.
Right.
I might also, by the way, because the stock at 84, 85, with a little bit of capital, you go buy some January 80 puts that makes it look like there's going to be something going on. So maybe you give Morgan an order to buy 1,000 Jan 80 puts, then you go position limit with you use a firm that doesn't know what the heck it's doing. Maybe you go to UBS for puts. And you just kind of create an image that there's going to be news next week, and that's going to frighten everybody.
Right.
Then they all go out and say large put buyer UBS. And then they call Pisani again. You have to use those guys and say, listen, I see a big buyer of puts, and I'm told that it's SAC. You would do that too. And these are all what's really going on under the market that you don't see.
Right, and nobody else talks about it.
Right, but what's important when you're in that hedge fund mode is to not do anything remotely truthful. Because the truth is so against your view.
Right.
That
Yep, I'm playing that again.
It's important to create a new truth in that hedge fund mode is to not do anything remotely truthful. Because the truth is so against your view of what's really going on under the market that you don't see.
Right, and nobody else talks about it.
Right, but what's important when you're in that hedge fund mode is to not do anything remotely truthful. Because the truth is so against your view that it's important to create a new truth, to develop a fiction. And the fiction is developed by almost anybody who's down like 2% to up 6% here. You can't take any chances. You can't have the market up any more than it is if you're up 6. Because starting Jan 2, you'll have all your money come out. So what would you do if you're in that situation and you feel like you're desperate? Is that you would do these actions.
So you're talking about the mechanics of the market.
Well, the mechanics are much more important than the fundamentals.
There you go. That's the first piece of the puzzle that I want to address tonight, except I'm addressing it backwards. Mechanics are more important than the fundamentals. And that's exactly the argument that Chamath was just having, right?
Okay, well, but in terms of the fundamentals, you've been writing about how you
think... Who cares about the fundamentals? Research in motion just blew out the quarter.
Right.
But look what people can do. I mean, that's a fabulous thing. The great thing about the market is it has nothing to do with the actual stocks.
Right.
Now, and you feel like you're desperate, is that you would do these actions.
So you're talking about the mechanics of the market.
Well, the mechanics are much more important than the fundamentals.
Oh, okay, well, but in terms of the fundamentals, you've been writing about how you think...
Who cares about the fundamentals? Research in motion just blew out the quarter.
Right.
But look what people can do. I mean, that's a fabulous thing. The great thing about the market is it has nothing to do with the actual stocks.
Right.
Now, look, over maybe 2 weeks from now, the buyers will come to their senses and realize that everything that they heard was a lie. But then again, Fannie Mae lied about their earnings for $6 billion. So
right, and
Bristol
Myers lied.
It's just fiction and fiction and fiction. And I think it's important for people to recognize that the way that the market really works is to have that nexus of hit the brokerage houses with a series of orders that can push it down, then leak it to the press, and then get it on CNBC. That's also very important. And then you have a kind of a vicious cycle down.
Right.
And it's a pretty good game. And it can be played. You pay for a percent or two.
Right, and then do you get long before Macworld and the expectation that the iPhone is going to be good? Right, and then you go back, flip to the long
got to
side.
use the other side.
Yeah, you drove it down, so you might as well buy it low, obviously, right?
Interesting.
Yeah, and there's a case where I would say the January 80 puts can be justified because after I've knocked the stock down to 80, I can buy a lot of common. And then you play it right into Macworld where they'll probably introduce the phone and Verizon's going to take it.
Okay. Well, maybe the fundamentals don't matter, but let's talk about the Fed
remember,
a little bit.
what Wall Street Confidential is not giving you the party line. Oh, here's the party line, by the way. I spoke to Apple. The phone. I hear the phones are good, and Verizon might take it. And as a matter of fact, the research in motion sellers, I don't think they know what they're talking about.
But you've been writing about the cell phone market. You think is you don't want to be involved in that.
The problem with the cell phone market, frankly, is that these guys are all killing each other. Someone has to take a dive. Motorola and Nokia have to get in a room and just fix price. They've been reluctant to do that because of the various justice departments and because
it's illegal, right? Yeah.
Well, that hasn't stopped a lot of other companies.
This is true.
This seems to be a case where they seem to be directly worried about the authorities. It's almost as if they have a lawyer that matters, unlike, say, the Bristol Myers lawyers. And, what eventually happens is the shareholders demand that you get phony lawyers and you sit in the room. And it'll happen soon.
Real quick, the Fed, the numbers out today weaker than expected.
Oh, so what? The Fed has obviously got to cut. But, again, you call the various guys who cover the bonds and you say, ignore the bond action. What's really happened is the Fed is very frightened about, and then you gin up the number that they're really frightened about. The Fed is actually desperate to try to figure out, how quickly they have to cut without looking like dopes that they raised.
Right, because they've been talking about they're worried about inflation all this last few months.
You don't want to raise in May and then cut in January. You look like Mexico, for heaven's sake. I mean, this is like a distinguished group of people who went to really good schools.
Right, these are smart guys. Absolutely.
Yeah, they don't want to look like dopes.
But when we were talking earlier in the week, you said you think it would be some sort of crisis, possibly Ford being a trigger.
Well, Ford went and did all that, they pledged all this investment banking to all these guys, so now that they're very reluctant to say negative things, it makes it much tougher for the Ford story to play out. I mean, the amount of business that Ford has to do. Ford might be the big client of 2007. So if I were in the corporate finance room, I would say, listen to the research guy. I said, listen, I spoke with Mullally. I actually have the inside. The plan works. So then you're the research guy and you say, oh, man, what do I do? It's bonus time. I'm not going to be a total idiot. Spitzer's going to Albany. Let's get back in the game.
Right.
I think that's important.
Is it possible? Because a year ago at this time, a lot of people were saying GM's about to go bankrupt, and of course the stock's up 50-some-odd%.
Well,
could Ford be that stock?
They're GM. No, but GM. The difference between Ford and GM was that GM's balance sheet was never really. It turned out wasn't that bad. Ford's balance sheet's pathetic, and you know that because they were willing to screw over the common for the bonds.
Right.
That's kind of if it weren't Ford, if this were Qualcomm. We'd be saying Qualcomm is desperate, but no, it's Ford.
But it's Ford. It's an American icon.
Yeah, I drove a Ford. I owned a Ford once.
So he's talking about spinning the narrative based on what company and giving preferential treatment, right? Oh, this company, it's really bad, right? Versus Ford, it's okay, it's Ford.
This is our country. Well,
yeah, right. Balance sheet's pathetic, and you know that because they were willing to screw over the common for the bonds.
Right.
That's kind of if it weren't Ford, if this were Qualcomm. We'd be saying Qualcomm is desperate, but no, it's Ford.
But it's Ford. It's an American icon.
Yeah, I drove a Ford. I owned a Ford once.
And this is our country. Well, this has been Jim Cramer. Wall Street
Again, what I'm trying to go for in the Wall Street Confidential, and I'm not saying you're sending me. I have to talk about what it's like at my hedge fund, okay? And what other hedge funds do, because the difference is that. If this is an intraday show, and you need to know what I know is going on. Now, we step back. Research in Motion was a real blowout quarter. It was a really good quarter, and I was quite surprised how strong the margins were. It looks like the other guys have really dropped out. It's a terrific story. Should it be up 6? Yeah, I think so. But, look where we are. It's Friday. You got 5 more days to make your quarter.
Right.
Can you really risk having RIM up this much? I don't think you can.
Okay, and they're not. And if I'm correct, you're off next week.
Yes, I am.
Okay, and I am
You
as
know,
well.
right.
So we'll be back in 2007.
I'm hoping that
more of this.
we finish the year at 1260 because that's at 12,460 because that's what I said at the beginning of the year was. Now, yesterday we came in and we were 20 points away from what I predicted. You know, I want to nail it.
Do you have a forecast for 2007?
Yeah, but I'm not. It's over a series of 5 days, so people have to go to realmoney.com.
Check it out on realmoney.com. And Jim, thanks very much for being here. I'm Aaron Task. Stay tuned for more of TheStreet.com TV.
So? What did everyone think of that? What do you think of what's going on? That is a clip of Jim Cramer from a long time ago, back when he was a hedge fund manager, by the way, just to be clear. In case you couldn't tell by the poor quality, that's not because it's some weird rip of the video. It's because was the actual quality of video back then. This took place in 2006. He's talking about RIM, Research in Motion, BlackBerry, Palm Pilot, and the first iPhone, right? So all those conversations, Qualcomm chips in the first iPhone, those are the things that... so hopefully that gives you some context as to the time frame of that interview. But that was really Jim Cramer really talking about rigging the market with mechanics and not caring about the fundamentals of a company, right? Driving the narrative of a Qualcomm different than Ford just because Ford's an American company. So my point is to show you, right? Like, I'm not trying to be overly sensational, though that was a very sensational video. Mechanics and fundamentals are clearly two different things, right? We can do this all night. I have videos ready to go that show CNBC only cares about narrative. They choose their guests based on which one's going to get them more clicks that day, which is totally dependent on whether the stocks they're talking about are up or down, right? We can talk about this all night. I'm happy to be here and stay here. I know some people want to go watch AOC on Twitch, so I'm trying to be sensitive to that. I will definitely post this live stream to Ticker Symbol Live, so just so everyone's aware of the mechanic, Ticker Symbol U is my main channel. These live streams are obviously a little bit off color for the type of curated educational content I try to put out on Ticker Symbol U. So they're going on Ticker Symbol Live, which is meant to be a little more like uncurated, unrefined, my personal thoughts, real time, right? So I don't want anyone to get confused. I'm definitely going back to creating videos after video that will be more curated. And I plan on releasing more soon. Obviously, this is a hot topic that's still unfolding, right? The mechanics, the manipulation, the stock market. So I wanted to get something out in real time to stir a conversation while I'm doing my due diligence and forming like a more curated, streamlined, video-worthy thing on the main channel. So hopefully that kind of I've done 2 live streams back to back, so I just wanted to separate that out. So now what I'm going to do is I might be quiet for a second here while I just catch up to the chat, which I've been ignoring all night. If you've donated, thank you so much for donating. I saw a few supers pass me by. Thank you so much. I really appreciate it. If people joined the membership, I really appreciate that too. I'm sorry that I missed it in real time. I thought commenting on the video would be adding more value. And now I'm going to go through the chat real quick until I see the concurrent viewers kind of drop off here. We can keep going. We can watch Hyperchange talk about the mechanics of getting on CNBC and, who he's talking about. AOC is Alexandra Ocasio-Cortez. I hope I'm saying her name right. She's a Democratic congresswoman who's going to be on Twitch. She's already started her live stream about 15 minutes ago. I'm sure there will be a billion recordings of that. She's pretty charismatic, so some people like to see if she's going. Keep going. We can watch AOC later. It's a party. All right, let's do it. Here we go.
And names like GameStop and AMC. Joining us now in a first on CNBC interview, Interactive Brokers Chairman and Founder Thomas Peterffy. Thomas, thank you for joining us. It's great to have you on a day like today to help clarify what is going on. So explain to us, to our audience, why you have decided, like Robinhood, to restrict trading in shares of these companies like GameStop and AMC.
So simply put, we are worried about the integrity of the marketplace and the clearing system. this is a new scenario in which fundamental values do not matter. Stocks that are worth single-digit dollars go to several $100s. For example, Game today jumped up and down hundreds of dollars at a time. We are concerned about the ability of the market and the clearing systems to withdraw the onslaught of orders, to continue to provide liquidity, and we are concerned about the financial viability of intermediaries and the clearing houses. Now, I hope that your audience can follow this. For every option trade, there's a buyer and a seller. There are as many long options as there are short options. So when the stock moves either way, some options make money on one side, and the other side they lose money. The broker stands between his customers and the clearing house. So when some option holders make money, the clearing house has to give us the money to give it to our customers, while other option holder sellers or buyers on the wrong side lose money. We have to collect money from them and give it to the clearing house. If our customers are unable to pay for their losses, we have to put up our own money. Now, luckily enough, we have $9 billion of equity, so we don't have a problem. And we also have a very well automated risk management system, so we haven't really gotten hurt.
So this is pretty interesting. Here's a guy with a brokerage who stopped some of the trades from occurring, right? He stopped, for example, GameStop trades from going through, but he's claiming that he's in a fine financial position and that he was able to cover all of the trades, even if his clients weren't, right, during the short squeeze. What he was saying is, hey, if my clients can't turn around and cover their calls, we have to. And then he said, but we have $5 billion in the bank, so we're okay. So I wonder why he stopped those trades.
However, I cannot say the same thing with full confidence about other brokers. I really don't know where they stand, so I'm extremely concerned. As Game moved from $17 to $500, there are roughly 3 million contracts outstanding in the options market. If one of those options is worth, say, an average option I estimate worth about $10,000 now, so that is a loss of roughly $10 to $15 billion on the one side and $10 to $15 billion of gain on the other. I'm afraid that there may be brokers who may not be able to meet these margin calls. So that is the...
So just to be clear, you're worried about the middlemen. Are you doing this move to protect yourself or to protect your customers?
Partly to protect ourselves.
I think that's all we need to hear. I mean, I guess I'll play the rest of the video.
But mostly to protect, of course...
To protect your customers. And are you doing this move to protect yourself or to protect your customers?
I guess this would be a good time for a short channel poll. I don't know.
Partly to protect ourselves, but mostly to protect, of course, to protect our customers, but most of all to protect the marketplace, to protect the clearinghouse. So if there are $10 to $15 billion of losses in there, somebody has to pay them. Will they be able to pay it? Is the big question.
Thomas, do you understand people's anger, your customers' anger, given that essentially you changed the rules of the game right in the middle of the match, at the most important moment in the match? Even if your terms and conditions allow you to do that, do you understand their anger that you changed the terms of trade for them just as things were getting heated up?
I do, but when you say right in the middle of the game, then you're saying as the squeeze is going on, stronger and stronger.
That is what he's saying. He's saying that the mechanics of the market are the mechanics of the market. Those are the rules of the game. It's not about fundamentals always, right? Like, it's about understanding the mechanics and the rules of the game you're playing, such as short squeezes occur when the majority of people are short on a stock and it gets bought enough to drive up the price and force people to cover their calls. So what he did was he protected people from covering their calls, even though those were the rules of the game.
but that's illegal. That's manipulative. So it cannot be done.
By the way, nothing about this short squeeze was illegal. It was all rules of the game. They were not rules based on fundamentals. They were rules based on mechanics. And hopefully you're seeing the common thread between all three videos that I've shown you tonight is that we're fundamentally arguing about the fairness of the mechanics of the stock market, the structure of the stock market itself, not the evaluations of the companies that get bought and sold on it, right? The mechanics of the buying and selling are rigged in one team's favor or the other, and I'll leave it up to you to decide which team is favored by those mechanics today.
So do you think...
Also, I think somewhat responsible for what our customers are doing.
Shepard Smith here. Thanks for watching CNBC on YouTube.
All right, I'm seeing a lot of questions like, can you explain GameStop? GameStop is a physical store that used to sell physical games. You would literally walk into a mall, and you would like shop around for video games. Think PlayStation, Nintendo, Xbox, whatever. And you would buy the physical copy of the game at this physical store. So GameStop over the years has been hit twice. It's a depressed stock. I mean in two ways, right? The first way is physical storefronts, physical retail is on the decline, right? Because of things like the pandemic and increased sensitivity to, going contactless, social distancing, staying at home, not going out, and all that stuff. The second thing is it sells a physical product in the digital era, right? And back to ARK Invest, we see that everything is going digital and software is eating the world. A clear example of this is simply you can digitally download a game and you don't need the plastic box, the physical CD, whatever. You can just download the game and have it. You don't need to leave your house to go buy it. And more importantly, because GameStop's actual trade-in prices and selling model was pretty bad, you're never really encouraged to trade in and sell games anyway, which is arguably one of the only reasons to own a physical copy, besides letting a friend borrow it, which now you can do digitally with most things. It wasn't worth selling your physical copy, right? So the only differentiator GameStop has, allowing this physical exchange of a video game, it didn't really take advantage of that in a meaningful way. So again, GameStop is akin to, or was akin to at the time of the depression of its stock price, it was akin to the Blockbuster of video games. As people have pointed out in the chat, it's trying to pivot into the digital era and do all these other cool things in the video game space. But back when the shorts started and people took their initial positions in the company, and these mechanics started playing out, I think it's fair to say that GameStop was like the Blockbuster of video games. Fundamental issue, type of behavior is allowed. Yeah, exactly. That's all I'm trying to point out with all these videos is this kind of behavior is not only allowed, but as we saw in the Jim Cramer video, it's encouraged. And big financial institutions who pay mathematicians and scientists lots of money to understand things like, covered calls and all these spreads and, put to short ratios and all the different options, calendars and all that stuff are encouraged to manipulate the media, which is why I'm harping on CNBC so much, right? The one thing you might have noticed is that all of these videos are from this same channel, right? And why is that? Because that's the soapbox that all of these people go on to pump a stock up to sell it, or, secretly whisper that this stock is bad in order to buy it low right before a big event where they can sell it high later, right? The one common thread through all these videos, besides them being hilariously corrupt, is they're all taking place on CNBC.